This video was brought to you in part by SD Bullion.
At SD Bullion, our everyday low prices are already lower than the big boys' so-called flash sales. One of the fastest growing bullion companies in the country, SD Bullion, just claimed a spot on the prestigious Inc. 500. So you have to ask yourself, why haven't you joined over 30,000 new customers who've recently made the switch to SD Bullion for the lowest gold, silver, and platinum bullion prices? To learn more, go to www.sdbullion.com and enjoy the lowest prices in the precious metals industry, period.
Hey everyone, I just launched a new website, financeandliberty.com. Please follow the link in the description of this video and subscribe to our free newsletter, where you can keep up to date with all our original interviews, along with some of the best financial videos and articles from the web. Hey everyone, this is Elijah Johnson with financeandliberty.com, and with us today is Craig Hemke from tfmetalsreports.com. Craig, thank you so much for joining us today.
Hey Elijah, it's always a pleasure.
All right, well, it's been an eventful couple of weeks. Last week, Trump became president-elect. This was a huge shock for basically everyone in the mainstream media. With a Trump win, what we saw on election night when that initial shock hit the markets, hit the futures markets, we saw the stock market just collapse. The Dow futures were down 700 points, I think, at once. But then the next morning, it's like nothing bad's happened. Now we're at all-time highs for the stock market, and gold and silver is crashing. What is your perspective on what's happening right now?
Isn't that interesting, Elijah? If I'd told you a week ago that Trump would be elected and the Dow was going to move 1,000 points and gold was going to move $100, you would have probably thought gold up and Dow down, right?
Yeah, definitely. That's what a lot of people were predicting.
Instead, we get the opposite. For me, I'm just going to lay this again at the feet of high frequency trading and how computers dominate everything. And that, because I still will always contend that there is no real stock market, at least not in the sense of what we traditionally viewed the stock market, of rational people making decisions based off fundamentals, such as earnings and P ratios and forward guidance and that kind of thing. 80% of the volume in the stock market now is high frequency trading. It's probably even more than that in stock index futures. And so it is very easy on a very large scale for the stock market to be moved one way or the other just by having some of the key high frequency trading inputs be affected. And we saw that Tuesday night into Wednesday, when initially, as the results were coming in, the dollar yen, which is the most important input of all for pretty much every market, including gold, the dollar yen sunk dramatically and fell from 105 down to 101. And when it was at 101, the S&P was limit down, the NASDAQ was limit down, and it was looking like a real tough day was coming on Wednesday following the election. And then magically, the dollar yen began to crawl off the mat. And by morning, it was almost back to unchanged. And by later in the day, it was up. And lo and behold, your stock market has a massive move. Now, an intraday move like the stock market saw in the U.S. has only happened 3 times before. It happened twice in October of 2008. And it happened shortly after the great crash in October of 1987. And most folks look back on those times and those major turnarounds and ascribe all of the credit, if you will, to the intervention of the president's working group on financial markets, what we loosely call the plunge protection team. Well, if the other 3 occurrences were all due to the plunge protection team, it's not a very long walk to assume that maybe the crawl off the mat last Tuesday night into Wednesday was also some type of plunge protection team induced surge. Now, in the time since, there have been some dramatic changes in the markets, most notably, Elijah, in the Treasury market. We saw on the day after the election on last Wednesday, the largest one-day percentage move in the U.S. bond market in history. Okay, so the biggest percentage move ever occurs the day after Trump's elected. Now, some folks have said, well, that's because Trump's going to, have some massive infrastructure program and there's going to be all of this new inflation. And frankly, that was news to me. I hadn't heard him championing that really much at all during the campaign. But that was the reason behind this massive sell-off. I would ask people to look a little deeper. Perhaps the massive sell-off, and again, we don't have a way to confirm this at this point, but perhaps the massive sell-off is some sovereign nations around the world, including China, looking at the reality of a Trump presidency and heading to the exits with their treasury bond portfolio ahead of time. You know how Trump has vowed to put 45% tariffs on all Chinese goods. Maybe the Chinese, in anticipation of that trade war, have said, you know what, the heck with this. We've got our $1 trillion in treasuries. Let's start unloading this rapidly. You unload those rapidly, all of that selling dumps the price of bonds, and bond prices going down means higher rates. And again, the largest one-day move in history. There's a lot of stuff going on behind the scenes, Elijah, and I'm afraid that the craziness, the volatility is really just beginning.
Definitely. And in a recent article you posted, you said that right now with the surging dollar and other currencies falling, especially the yuan, this could actually signal that a stock market crash is ahead, and a gold and silver market movement higher is also ahead. Can you discuss a little bit why you see that ahead?
Well, we've seen this play out before, most notably, just really in the last 15 months. This has happened now 3 times. The Chinese and the People's Bank of China have pegged the value of their currency, the yuan, to the dollar. Now, it's not a strict peg. They can still somewhat devalue it against the dollar to ease pressure on the yuan. Because again, if they're pegged together and the dollar is rallying, as it has, in fact, the dollar index is back to multi-year highs in these days after the election. Well, that means the yuan is back to going up as well. The Chinese don't want that. They'd rather have a weak currency because they're an export-driven economy. So they see their currency getting stronger, and they're left with this kind of a push and pull, not what are they going to do? They like having the peg to the dollar, but when the dollar's strengthening, they don't want a strong yuan, so they devalue it. What we've noticed is that yuan devaluations, active devaluations, and now we've seen several of them over the past 15 months, have been followed, rather closely followed within days or weeks, with a kind of a tumbling liquidity crisis that ultimately results in a big sell-off all the way into U.S. stocks. If you go back to August of last year, remember that Monday, the 24th of August, Elijah, when the stock market, so many things open limit down, and we almost would have crashed if it weren't for all of those trading collars. Remember that was August 24th of 2015. You might remember that. That was about a week to 10 days following a significant period of yuan devaluation. Stress in all of the emerging markets in early August, and it all spilled over as the U.S. market was collapsing the week of the 17th of August. It culminated that Monday, the 24th. Then you get into late last year. The Fed finally got around to raising interest rates. The U.S. dollar was surging to a level that it is about now in the dollar index. And the Chinese and the emerging market currencies were all beginning to roil and rock again. There was a significant period of yuan devaluation, again, about 3% over the course of the month of December. And if you look back then, beginning on January the 1st and extending all the way in, by the next 2 or 3 weeks, the U.S. stock market melted down about 10% again. So immediately hot on the heels, not right at the same time, but within a week or two, great weakness as liquidity kind of seized up around the planet. There was even kind of a mini yuan devaluation back in June of about 2.5%, and the stock market was down 5 or 6% then, but also, kind of culminating with the sell-off on Brexit night. So now here we are again. The dollar has been soaring for the last 2 months, really, from 94 to 100 on the dollar index. So that's a pretty good percentage move. And now the Chinese, especially in the weeks since the election, are actively devaluing the yuan again on a daily basis. And it is now down almost 3% again. And so if you can kind of see how this is all kind of lining up. And so I think it is logical, based on previous history, to assume that there's going to be a little pressure on the U.S. stock market in the next few weeks. And again, that's not anything anybody's expecting, right? We're, hey, everything's great. We're going to Dow 20,000. Woo, it's going to be, that might catch a few people by surprise. And then tying this to gold, with gold often catching kind of a safe haven bid during times of stress. And again, dollar was easing back off during those periods as well when the stock market was going down. Those very same periods where we had yuan devaluation followed by within a couple of weeks of a stock market correction, if you will. During those stock market corrections, we also saw significant rallies in gold of 10, 15%. So if this all comes together, the Chinese keep devaluing the yuan because the dollar is so strong. Eventually that spills over into kind of a liquidity crisis. The Dow collapses by 10%. Maybe we'll get a 10 or 15% rally in gold from here. And that too would catch almost everybody by surprise. Every perma bear in the world is out in force these days talking about gold making new lows. A rally from here would certainly catch, like I said, a lot of folks by surprise. And recent history would suggest it may very well be coming.
Now, what about the Fed meeting coming up? If the Fed raises interest rates, how will that impact the markets?
Yeah, you wonder about that too, because much of this dollar rally from the, like I said, 94 on the dollar index 2 months ago to today, yeah, some of it has come after the election, but much of it was based upon the idea that the Fed was going to raise the interest rates in December. Some of the economic data has led some people to think it's just almost a done deal. And now that long rates down on the long end of the yield curve have gone up so much, there's certainly room, if you will, for them to raise on the short end too. LIBOR rates have gone up. I mean, everything's gone up but the Fed funds rate. So maybe they will, maybe they won't. It may very well be at this point that any Fed action at the meeting, which is in about a month, is actually kind of baked in. Any news of a Fed rate hike in December may actually be a kind of a sell the rumor, buy the news event for gold. And that, okay, at least that's finally over with. And even if the Fed then projects that, oh yes, we're going to raise rates 3 or 4 times in 2017, I would remind everybody that that's exactly what they said last December when they raised the Fed funds rate. They promised us 3 or 4 rate hikes in 2016, and so far they've delivered a grand total of 0. So we'll see if what the Fed actually does come a month from now. But I, for one, wouldn't mind just getting that rate hike behind us so that we could stop worrying about it. And then if it does actually happen, it may end up being an actually what we call, again, that sell the rumor, buy the news type event for gold.
Now, when it comes to the Fed, I'd like to move our focus a little bit back to Trump. Now, he has said in the past that he would want to replace Janet Yellen as Fed chair and replace her with a Republican Fed chair because Janet Yellen is Democrat. What is your perspective on that? Do you think Trump will end up doing that? And if so, how will that impact how the Fed is run?
I think the natural inclination is to think that if Trump nominates somebody, it would be with someone a little more hawkish. Yellen has always had a reputation as being this kind of uber dovish, loose money type. Okay, maybe he will, maybe he won't. At the end of the day, though, I personally am not sure it would matter much, as the Fed is always going to do what its owners want it to do. Remember, the Fed is a private institution owned by the big banks, set up to run and maximize profits and help the big banks as much as possible. If by extension, a secondary or tertiary effect, it somehow helps the American people, then fine. But the Fed is there as a tool for the banks first and foremost. And so, yeah, you know what? Mr. Trump may nominate somebody else to be the head of the Fed, but the Fed is still going to do what is best for their banks before anything else. And so maybe I'm just being a little too cynical, but I would think that perhaps it doesn't really matter who Trump puts in as head of the Fed.
And that gets kind of to a larger point is, Trump has talked about that he wants to, quote, drain the swamp in Washington. Do you think he's actually going to be effective in doing that and getting the corruption out of there? Because it seems like you're saying it doesn't really matter who the president is. The Fed is still just going to do what the banks want.
Yeah, let's take that two different directions, Elijah. One, I think that drain the swamp, the metaphor, was extended by a lot of folks, especially in the gold community, into thinking that that meant Washington or New York as well. That somehow we were going to get a new SEC chair, and that maybe a new attorney general was finally going to go after the banks, and there'd finally be some perp walks, and do the job that Eric Holder and Loretta Lynch have failed to do. But he never really indicated that, though, did he? When he was always talking about drain the swamp, it was just Washington, D.C. that he was talking about. And so to your point, can you drain the swamp? Is it irreparable? Is it broken? Is it terminal? I'll try to remain optimistic. And again, I don't want to sound overly cynical, but that's going to be hard to do given the entrenched, let's say, a dominance of what I've always called that political financial complex. The politicians need money from the banks and the lobbyists so that they can all get reelected and maintain their power and enrich themselves. And the banks need the politicians to expand government and expand spending so that more and more money is created and they can charge more interest on this newly created money, and they put it all to work and do their investment banking and everything else. And there's just kind of this unholy alliance between the two. And for one guy to come in and set a new agenda and change that, I think it's going to be tough to do. Beside the fact that he's going to be considered a real threat to anything that the status quo has. And if he does play out as a real threat, you can bet that they will take every measure possible to try to coerce him to not pursue that agenda. So again, I hate to sound like I've always said, Elijah, it's kind of a fine line between being cynical and being realistic, right? So I don't know if I'm one or the other. I just don't hold out a lot of hope that much substantial is going to be changing.
Now, what about for the economy? How do you think a Trump presidency and, for example, Trump's tax code will impact the economy?
Well, there is no doubt. As a small businessman, I can tell you things like Obamacare, the Affordable Care Act, are a disaster for small business creation, for job growth. I mean, it's a total disincentive, and it ranges to all these different regulations from Obamacare to just the myriad of regulations that Obama and his executive actions and his bureau heads have all pushed through in the last 8 years. So if Trump can rescind some of that, pull some back, smooth it out, he might create a slightly more positive environment for business creation and job growth and that kind of thing. So that might be beneficial. I don't know what the impact would be if he really does succeed in lowering the corporate tax rate. And these trillions of dollars that they talk about that are held overseas actually come back to the U.S. Some folks think that would be this positive, great thing, but I don't know about that. And that it's kind of like the petrodollar, dollar recycling scheme. Kissinger set it up in 1973, at least had the idea that if we could get the Saudis to price energy in dollars, there would always be demand for dollars. Those dollars that we print would get soaked up overseas and then plowed back into treasuries and, in a sense, incubated and not be sitting around, sloshing around back here in the U.S. causing rampant inflation. And I just wonder if Trump does succeed in lowering that corporate tax rate and suddenly, I don't know, $2-3 trillion, whatever it is, comes flooding back onto our shores. I just wonder if that wouldn't be terribly inflationary. And without the facility to sharply raise rates or the ability to sharply raise rates the way Paul Volcker did in 1979, 80, and 81, we could finally get into some significant, if not maybe hyperinflationary is too strong of a term, but some significant price inflation. And given the stress that the average family is already feeling, with a husband and a wife both working and trying to pay taxes and tuition and healthcare costs and caring for their parents and everything that goes with it, all of a sudden you start getting double-digit inflation out there. It can get really nasty really fast. And so it's really, I guess, as I put it all together, that's just one little aspect of Trump's economic policy that I would suggest may have a negative impact rather than just the assumed kind of on the surface analysis positive impact that so many are thinking.
Now, in my point of view, it seems like, whoever's in power, the dollar, just if you look throughout history, all fiat currencies have collapsed. And I don't think the dollar is going to be any different. And I know on your website, your slogan is preparing for the end of the great Keynesian experiment. As we close this interview, did you want to just discuss your website's motto and how people can prepare for the end of the dollar?
Well, the Keynesian experiment is this idea that you can just rapidly expand the debt base, the monetary base, and almost do it indefinitely or to infinity. And I think a realistic view of where we are in our debt-based society almost makes you feel like we're at the end. Now, the end has been held off over these last 5 years through these low and even negative interest rates, in that if you look at the federal budget in the U.S., it has, even though it's reported at $600 billion and the debt, though, is going up by over $1 trillion a year, and I don't even want to try to square that circle, but even at $600 billion annual deficit, more than half of that, just that deficit, comes from the line item of interest on the national debt, which we know is the debt itself is more than doubled under the last 8 years of Obama. So how could interest be going sideways? Well, that's because the Treasury Department has moved most of their borrowing, all their outstanding bonds and notes, into about the shortest duration yield as possible, because down on the short end is where you find the lowest interest rates. But now if interest rates begin to rise, as they already have rather dramatically, then all of that $19-20 trillion in debt has to get refunded at a higher rate, and then maybe an even higher rate a few years later, to where that interest on the national debt goes from $400 billion to $800 billion to $1 trillion a year. And these deficits, which have been somewhat contained and thus forestalled the end of the great Keynesian experiment, these deficits begin to move wildly out of control. And you just simply can't print and create and devalue your fiat currency fast enough to service that debt any longer. And that's where it all just begins to, like I said, move toward kind of a collapse stage. Like I said, the move toward lower interest rates has kind of forestalled that for the last 5 or 6 years. That doesn't mean it's not mathematically a certainty that this is still coming. So with the new Trump equation getting factored in, who knows what the next few years will hold. All I know is these changes are definitely coming. As you said, no fiat currency lasts forever. No country has held the power of being the world's reserve currency forever. We took over from the British, and before them, the Portuguese were. I mean, there were all kinds of different countries had the reserve currency of the world. Our time is fleeting and it's transient as well. So we prepare for that at TF Metals Report. We don't know when it's coming, but we know we need to be using this time wisely because we know it most certainly is coming. And I encourage everybody to check out our site. It's a great like-minded community of folks that are all kind of realize we're in this together. Again, tfmetalsreport.com.
All right. Once again, Craig Hemke, thank you so much for joining us today. Are there any last thoughts you'd like to add?
Elijah, it's going to be a wild 2017. In 2016, we dubbed a year of consequence at TF Metals Report, knowing that there were going to be all kinds of significant things are going to happen this year. I would say that's probably going to extend into 2017. And anybody that sits here and tries to tell you with 100% certainty that they know what's going to happen, that they know how this is all going to shake out, that they know which way all these different markets are going to move in the short term, they're crazy. This is a wildly volatile time that we have coming at us with all kinds of unpredictable events and unknown unknowns, as they call them. And I just encourage everybody to try to stay on top of it as best they can and to not get complacent and to guard their finances carefully in the weeks and months ahead. This video was brought to you in part by ReluctantPreppers.com.
Click here to watch Reluctant Prepper's latest interview with Murray Nye, CEO of Winston Gold Corp. In this interview, Murray Nye explains how gold miners can outsmart price suppression.